Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy implications. I'm Govindraj, Ethiraj. Parliament is back in session and all eyes are on whether the much-awaited Goods and Services Tax Bill will get passed. If it does, India could be much closer to a common market with free movement of goods. Among other benefits, the challenge right now is for the government and opposition to agree on the common GST tax rate that will come into effect. The opposition wants it at 18%, while the government is inclined to a higher number. Now, what are the pros and cons of the rates being suggested, and what impact could it have on the price we pay for goods? And more importantly, what else needs to be done to get it going? Here's a report.
Looking to resolve the GST stalemate, Prime Minister Modi invited main opposition party Congress President Sonia Gandhi and former Prime Minister Dr. Manmohan Singh to tea on Friday evening. On his side, Finance Minister Arun Jaitley and Parliamentary Affairs Minister M. Venkaiah Naidu were present.
माननीय प्रधानमंत्री जी ने पूर्व प्रधानमंत्री डॉक्टर मनमोहन सिंह जी को और कांग्रेस पार्टी की अध्यक्षा श्रीमती सोनिया गांधी जी को संसद के मौजूदा सत्र के कई विषयों के संबंध में बातचीत के लिए आमंत्रित किया था। प्रमुख विषय गुड्स एंड सर्विसेज टैक्स को लेकर संविधान संशोधन का भी था, जिसके संबंध में कांग्रेस पार्टी के दोनों नेताओं से प्रधानमंत्री जी की चर्चा हुई। कांग्रेस पार्टी की तरफ से जो उनका 3 विषयों को लेकर जो उनके सुझाव थे और उनको कहना था, उन्होंने अपनी पोजीशन स्पष्ट की। उन तीनों विषयों के संबंध में सरकार की ओर से जो उस विषय का इतिहास है और जो सरकार का रवैया है और जो हमारे हिसाब से तर्क और तथ्य हैं, वो हम लोगों ने कांग्रेस पार्टी के नेताओं को दिए हैं। सरकार की बातचीत चर्चा करने के बाद वो अपनी पार्टी में इसकी चर्चा करेंगे और कुछ समय के बाद चर्चा करने के बाद इसकी संभावना भी है कि सरकार और प्रमुख विपक्षी दल की दोबारा इस विषय पर बात आगे चलती रहेगी।
We are the original authors of the GST. Therefore, the 3 points that were raised by the Congress party, or the 3 demands, I would say. One is on the scrapping of the 1% surcharge, which would have a cascading effect and make the GST very high. Second, capping the GST and making a provision for that at 18%. And the third is a meaningful dispute resolution mechanism.
The meeting assumes significance as the government and the Congress are at loggerheads over the passage of crucial legislations. Vishal Dahiya's report for Rajya Sabha Television.
Well, joining me now to discuss that are Santosh, Sonare, Executive Director of KPMG, and MS Mani, Senior Director at Deloitte, India. Gentlemen, thank you very much for joining us. So, Mr. Mani, let me begin with you. So, what are we looking at? When we say there is one side asking for 18%, there's another side saying 21 to 22%, what does it really mean to me as someone who's going to be purchasing goods and services? And what could be the impact on a longer term basis?
Okay, I think the first thing we need to keep in mind is the fact that it's not a question of 18 versus 22. It's a question of what should be the rate which is termed as a revenue neutral rate. Now, without getting too much into the technicalities of it, there is a panel formed by the government, which is led by the Chief Economic Advisor, which is expected to frame its report somewhere in the first week of December. But as a consumer, typically when we look at it, the goods today are subjected to an excise duty and a VAT. Now, the excise duty varies, but typically is around 12 to 14%. The VAT also varies, but typically somewhere in the region of again 12 to 14%.
So
when you add up the two,
12 plus 12, yeah.
Exactly. So when you add up the two, you're already paying anywhere between 24 to 26. Now, on the other hand, if you are a consumer of services, you're only paying a 14% of tax. So the challenge for the government is to find a rate which is good for goods and is good for services at a uniform rate. And that is the reason if the rate gets agreed at 18%, what it would mean to consumers of goods is that prices should come down. It will certainly not have an inflationary impact. It will be very good for the economy, provided the manufacturers pass it on to the consumers. As far as the service sector is concerned, it would be a little inflationary, but that again would be controlled because majority of services are B2B services. And B2C services typically do not attract too much of service tax.
Okay.
And on B2B services, there is a credit mechanism available.
So when you say business to business and business to consumer.
Exactly.
So consumer would mean like telephone bills and so on?
Exactly. Consumer would mean telephone bills and a laundry service and a beauty parlor service and stuff like that.
Okay. So that's the rate part. Santosh, what else is there in are we looking at when it comes to agreeing on a GST package?
Then there are too many stakeholders. Consumer always wants right tax so that his total cost, so that he is able to buy more from the pocket money he gets from his pocket. Effectively, the other factors is what is the revenue neutral rate which Mani just mentioned, which is the trigger point of deciding whether 18 or 21. Okay, we need to find out the right rate at which the state governments would get the same revenue in future under GST regime effectively. Now, identifying right balance is critical. Other factors is if you are able to subsume all the taxes together, and if all state governments get right to tax most of the services, including B2C services, some of them which are not covered today, there would be significant tax inflow for them. And therefore, between 18 to 20% could be a good rate to look at.
Right. In any case, even if it's 18 or 20%, the states are likely to lose, but the government will compensate for them.
Absolutely.
The central government will compensate.
At least for 5 years, they are saying we will definitely compensate.
Right.
And we'll see the trends after 2-3 years. Suddenly, you will see a lot of buoyancy in economy.
Right. So, what are the other areas of concern? Is rate the only area of concern right now?
So, there, as I mentioned, there are different stakeholders. So, if you look at consumer is only looking at rate because that's how the inflationary impact and the impact on prices GST is going to have. If you look at business, there are structural concerns on GST, that 1% additional tax on interstate transfer or supplies of goods is a bigger concern because the credit for the tax paid may not be available. As of now may not be available. So that is one concern. Other state governments also have concern on their revenue. So they're bringing in whether they will also have right to include petroleum products as a subsequent stage, right to tax alcohol, which is currently with the central government only. So these are some concerns, and specifically what we have heard from news reports is that whether there will be a dispute settlement authority being brought in under the constitution is also a challenge. So how do we address that part within the political framework is critical.
Okay. So, Mani, if we were to now look ahead, assuming we have to get this going now and we have to bring everyone onto the table, what are the areas where, let's say, people could compromise in your mind?
See, the 1% tax, the 1% additional tax is something which has been introduced into the GST discussion just a few months back. It has never ever been discussed before. And that is something which is going against the basic principles of GST per se. So that's something on which there can certainly be a compromise because it's not good as a structure and it has never been there in the past.
So why was it brought in?
It was brought in because GST is expected to be a destination-based tax compared to the present system where there are origin-based taxes. So the manufacturing states wanted to have some kind of a compensation in terms of goods which are manufactured in their states but consumed in other states. And therefore the manufacturing states prevailed upon the select committee of Rajya Sabha, which undertook this exercise a few months back. And they said that we need to have some kind of a compensation for goods which are manufactured in our state, on which we were getting a revenue in the past, but now we are not going to get a revenue.
Okay, right. So you're saying one is we can do away with that.
We can possibly do away with that. That has not figured anywhere in the past. The other aspect in respect of how will the dispute settlement system work under GST. Now, even in the past, all the discussions which have taken place suggested that this is something which would be decided by the GST Council. Now, putting a GST settlement authority in the constitution seems to be something which is, a new demand. It's not something which has been on the table,
in the past.
And therefore, this is also something which can be discussed, and it may be a good practice not to put this in the constitution. Because
including
the process of
including
the rate, because the process of amending the constitution is pretty tough. So we have seen in the past what happened to FDI on insurance. And taking the FDI cap on insurance from 26 to 49 became extremely difficult because that was through a constitutional amendment. Had it been through an executive decision, possibly it would have happened much quicker. Consequently, when today, if there is a concern in respect of the Dispute Settlement Authority, it may make sense to give that to the GST Council when the GST Council is formed, rather than an insistence that it should be part of the Constitution.
Okay. So let's to recap, Santosh, how will life change, assuming, let's say, at 18% or 20% or whatever that happens? How can the efficiency in the economy improve, or could we see growth as well? Could we see a GDP kicker?
Definitely. What GST promises is that there will be no double economy. So most of the activities happening in cash transaction would get covered by the GST framework. Plus, for business to business,
some people may not like that.
Absolutely.
Yeah.
So that could be point of opposition, may not be in front but in the backdrop of the mind. Second point is for B2B customers, today they are not getting tax credits of the taxes paid on procurement. So let me talk about a trading company importing goods and selling in domestic market. Today they don't get credit of the taxes paid effectively. So excise duty and at 2.5% and service tax at 14%, they will not get the credit. Now all these taxes paid on procurement, if not available set off, ultimately reaches to consumer in terms of the price increase enhancement. So that is one important factor which everyone looking at from GST, that GST is going to simplify the way we do business, and tax will not be a factor for determining whether and where I want to locate or invest today. Otherwise, if you look at a lot of companies have been formed in but the tax-free zones, which are not close to supply or procurement zones, but still we have a lot of development happening in that particular zone. But business dynamics will be independent of tax. That is one critical impact of GST.
So, and you're saying these locations could lose their relevance?
To some extent, unless until government protects them in some other manner.
Okay.
Effectively.
Okay.
Yeah. So it will be natural supply chain effectiveness, which can bring in more efficiency in the economy. Right. So whether it is centralized sourcing, whether centralized distribution, that will kick in.
Right. And that's a larger thing that hope that GST will bring in. Free movement of goods?
Free movement of goods, certainly, but one thing I wanted to add was as a consumer, one key change which will happen when GST kicks in is that today in several establishments, a consumer does not get a bill or an invoice unless a consumer asks for it. And there is no incentive for the seller to issue an invoice. Now, once GST kicks in, the seller will have an incentive to issue the invoice because he will not get a tax credit unless he demonstrates the sales of those products. And consequently, we will start having more and more establishments which may typically put up a notice which say that if you don't get a bill, treat whatever you have bought as free.
Free, okay.
So it will not be on the part of the consumer to ask for a bill.
Right.
The onus will be on the seller to issue a bill because it's good for him.
Right. So let me ask the last question once again. So what would you think is the compromise point in this whole debate?
At a very broad level, I believe there is merit in asking for a rate of 18% because any rate above 18% may be a little inflationary. But this need not be put as part of the Constitution Amendment Bill.
Okay.
This can be agreed upon.
Okay. Last word, Sonare.
Effectively, I think we are looking at government to act upon it and opposition parties to really support the bill. The inclusion of petroleum products, I think if they bring in as part of GST, as rightly mentioned by Mani also on other points, they should not be part of GST.
Well, we've run out of time. We need to go in for a break, but coming up on the other side, we talk about non-performing assets and why that problem isn't going away. Stay with us. Welcome back to Policy Watch. India's bank non-performing asset problem is still getting worse, with gross NPAs rising almost 25% year-on-year in September 2015. On the other hand, rating agency Equirus says NPAs will come down to 5.5% from 5.9% it had projected earlier because NPAs are getting restructured. Now, this could be good and bad news, particularly if the stress is being masked. High NPAs put pressure on the entire banking system and their ability to give fresh loans and help the economy grow further. So the question is, are NPAs coming down, or does a sluggish economy make matters more difficult? Here's a report.
Calling bad debts of banks a legacy issue, the finance minister is confident that banks can win their battle against willful defaulters. According to him, the imminent bankruptcy law will only empower them further. Gross NPAs of public sector banks rose to 6.03% in June 2015. They were 5.2% in March 2015. In August, the government announced 70,000 crore capital infusion in PSBs over 4 years, starting with 25,000 crore this fiscal.
Series of steps which the Reserve Bank has announced, which some of the banks have been implementing, will certainly improve on the quality of those assets. Additionally, the government also has been extremely proactive in responding to each of the sectors.
Jaitley also reviewed credit offtake by sectors like home, education and corporates, the Jan Dhan Yojana and Prime Minister's social security schemes.
The banking system, which is the lifeline of the economy, continues to fund various segments of the economy in order to grow. Now that the growth rates are somewhat picking up, and therefore the pressures of the past need to be removed as far as possible.
The government also has plans to sell shares in state-run companies when the market improves. It could raise about $14.4 billion by reducing stake in state-run banks to 52%. But so far, the government is struggling to meet its asset sale targets to plug its deficit. Kriti Mishra, Rajya Sabha TV.
Well, joining me to discuss this now is Saugata Bhattacharya, Chief Economist at Axis Bank, and Ajay Garg, Managing Director of Equirus Capital. Thank you both for joining me. So let me begin with you, Ajay. So what is the impact of this as we're seeing in the markets? And then let's try and understand what this means to the system as a whole.
So I guess, obviously because of the gross NPA levels and the NPA levels that have been going up for a period of time now, and one of the reasons, I guess we are seeing from the RBI also saying they can't reduce the interest rate, so the interest rate remains high. Definitely that has an impact on investment. We are not seeing any corporate investments happening, so corporate credit number is going down, which has a direct impact on the job growth market. I think these are the two significant impacts.
So you're actually saying the impact is pretty significant. It's not something to be ignored.
Yeah.
So Saugata, how bad is it today? I mean, so Equirus is saying that gross NPAs have risen. So is that a good sign in some ways because we are seeing what could be the worst of the situation?
Well, I mean, good and bad both. The technical reason for the increase in NPAs is because from the 1st of April, the RBI stopped its forbearance on adding fresh stressed assets into restructureds. So whatever banks were classifying as restructured assets is now showing up as NPAs. So that's the reason that you're seeing a technical rise in the level of NPAs. It's also good because the RBI and the government of India have set in place a series of measures and processes by which both the existing stock, the stock of existing NPAs, stressed assets, can somehow be resolved. I mean, from restructured into resolution, and going forward, the additional credit does not also lead to further NPAs. Things like the joint lending forums to identify stressed assets quickly, SMA accounting, stressed assets accounting, and so on.
So how does one distinguish between restructured and masked?
Restructured, essentially what used to be before, structured something. So I mean, this is essentially the story of solvency. So insolvent assets, insolvent companies versus companies that are stressed on liquidity. So otherwise the business foundations were good, but due to diminishing cash flows because of projects not getting stalled and so on. So, I mean, the projects inherently were good, but it would take some restructuring in terms of elongating the interest payment process, putting in moratoriums and principal and so on. But the underlying quality of the asset was good.
Right.
So that's the restructured part. And bad projects were needed to be declared as NPAs.
Right. So on the other hand, we are still generating NPAs, right, at a rate of roughly 3.3%. Now, what does that mean, Ajay? I mean, it obviously means that there's something fundamentally wrong in the underlying corporate health of this country, isn't it?
So I think, if you sort of look at a couple of sectors which are in deep stress, and I think that will also be linked in terms of, how you see the sector indexes of infrastructure stocks or real estate or capital goods stocks have performed over the last 5 years. It basically tells you that, we are, facing two big, obviously there is an investment challenges that are happening. We are seeing an economic challenge in this thing, coupled with whatever slowdown in China impacting the metal stocks and having its own impact on in terms of how companies who have made investments in projects in anticipation of growth. So the capacities have been put in, but obviously there's not too much demand out there. And on top of it, on the infrastructure side, there's been obviously what we have always heard about a lot of delays in project approvals, and that has got added to the problem. So I think if you sort of look at this fundamental situation, and then there is a cascading effect which has in terms of all the other sectors thereafter.
Okay, so Saugata, if we were to now look ahead, what's going to, everyone is working on this problem, but what really can resolve this? If companies are stressed, the economy isn't growing. One of the things Standard & Poor's said is that the economy needs to grow and demand needs to pick up, and therefore you would have potential solutions here. So assuming we don't have the funds to inject, the demand side is not looking strong, where do we land up then?
Well, so start with the assets first. Cleaning up corporate balance sheets, that's number one. The amount of leverage that companies had taken on. And in terms of everything that Ajay talked about, in terms of cash flows becoming worse, commodity prices coming down. So some amount of strategic restructuring has already started. Companies, other companies which are more...
we can see assets being sold.
Sold to those companies. So the extent of leverage is slowly coming down. So that's one. Secondly, banks' balance sheet, the exposure to these corporates, the assets, and the overall stock of NPAs. That's slowly getting cleaned out. One avenue are the new asset reconstruction companies that have come in. Many of these companies are better capitalized than they were before and can take on more of these stressed debts. You've just seen the RBI circular on allowing foreign portfolio investors to buy stressed bonds. In other words, them acting like vulture entrepreneurs, vulture capitalists to take on, so restructuring specialists can come in and buy out some of these bonds. So many of these initiatives are already in play. But together with that, the larger question of investments, remember there's a significant amount of capacity underutilization. So these capacities need to come in. To an extent, the 7th Pay Commission pay increases will come in, and that should aid some consumption to bring up capacities to par. But together with this, the government is also getting in more taxes and thereby having more resources to spend. So the government spending on roads and power transmission on some capital goods sectors is beginning to increase. The railways and defense are another areas that will potentially add to a significant amount, and that should get the production ball, output ball rolling.
Right. So let's come back to banks, right? So we were talking about this a little earlier. So one of the pitfalls of a high NPA situation is that banks actually start looking more at retail rather than lending to companies who in any case are finding it difficult to borrow.
Yeah, because I guess clearly there are not too many investments that are happening. So obviously there are not too many projects, not too much credit offtake from that perspective, because corporates are, if you sort of look at it, their balance sheet debt has gone up over the last 5 years. So there's a pressure to sort of bring it down before they really get back into the investment mode and spending mode. And obviously there continues to be deposit growth, there continues to be need to deploy credit. So we are seeing that more and more banks and more financial institutions focusing on the retail side of lending, and that sort of, if you sort of look at something like an HDFC bank, almost 55% of their book is retail, whereas in SBI 20%. So I think you'll increasingly see that for the banks to
but that's not good for the economy either, isn't it? Over time.
So if corporate credit doesn't happen, that means investment is not happening, so that has an impact on the job growth. So I think then the jobs will not be created as much as what.
So are we stuck in the middle of this vicious cycle, or are you seeing signs of us emerging from it?
So I think government is sort of taking some initiatives. It takes a time for that to play out in the market. We have seen that the government is also in recognizing the problem for some of the road projects which are being there. They are not really talking of only a BOT concept. It's your EPC contracts which are being awarded. That's sort of some movement happening there. In the DISCOM side, we are seeing the government trying to focus on how the recovery can happen.
State electricity boards and restructure loans.
So all those initiatives will help a little bit, but it's going to take time.
Okay, so that's one straight factor. Saugata, what's your outlook?
No, so that's I
both on the positive as well as the
completely
not so
agree. So typically, the state of a government EPC procurement cycle is anywhere between 15 to 20 months. So this government started in earnest around about September, October 14. And we are already 12 months into that cycle. So my guess is that he'll probably take another 5-6 months for the traction for these contracts that are being awarded either through the dedicated freight corridors, the road contracts, the electricity contracts, and so on, beginning to actually translate into orders for capital goods and things on the ground. But having said this, I think there are still a set of systemic constraints. The global environment is one, particularly trade, exports. So the trade engine is not working very well, so that's misfiring. So a lot of the capacities that had been built for exports is now being shifted back into the domestic area, so that's adding to capacity. As Ajay was saying, because of imports, cheaper imports from other countries, that's also adding to the overall supply. So there are many constraints that need to be addressed, and but the government is beginning the process.
Right. So last question quickly. So one of the challenges is transmission of interest rates or lower interest rates. So do you see that to be a continuing problem?
It's not a problem, it's a process. So that process will happen. We've already seen 65-70 basis points drop in bank base rates out of the 125 the RBI has given. And as the system goes along, remember there's still a fair bit of liquidity tightness in the system. But as more and more deposits get repriced with lower cost funds, you will see banks, it's in the interest of banks, given to the extent that they possibly can, to begin to lower the lending rates.
Okay, do you agree, Ajay?
Actually, you're seeing the transmission keep coming down. For example, the last 50 basis point drop, which RBI did, there was hardly any transmission on that one. Compared to the previous ones, which were there. So, yes, unless until there is, because you see the NPA level going, and if you sort of add the number, a lot of the public sector banks are actually very close to their tier 1 capital, being completely under pressure from that perspective, which is also reflected in terms of how you see the PSU bank stocks prices working vis-a-vis of a private sector bank. So I think don't expect too much transmission on the interest rate to happen till we start seeing a revival on the NPA cycle.
Right. We've run out of time as well. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.